Before we begin, please note that I am not a financial advisor, loan officer, or attorney. The information provided in this video is for educational and informational purposes only and should not be considered financial, legal, or tax advice. The VA Home Loan Program has specific rules and regulations that can change. You should always consult with a qualified professional, such as a VA-approved lender and a financial advisor, to discuss your individual circumstances and make decisions that are right for you. This is, without a doubt, the single most powerful mortgage product on the planet. I'm not exaggerating. A home loan that requires absolutely zero money down. A loan that has no monthly mortgage insurance, potentially saving you hundreds of dollars every single month. A loan with some of the most competitive interest rates available, backed by the full faith and credit of the United States government. This isn't some gimmick or a limited time offer. It's a benefit that you, our nation's service members, veterans, and eligible surviving spouses have earned through sacrifice. So why are so many veterans still renting? Why are countless military families struggling to scrape together a 20% down payment for a conventional loan, only to get hit with expensive private mortgage insurance, or PMI, on top of it? The answer is simple: a lack of knowledge. They think it's too complicated, that they won't qualify, or they've heard myths and misinformation that have scared them away. They're leaving the single greatest financial benefit of their military service sitting on the table, unused. This video and this entire series is designed to change that. Right here, right now, we are going to demystify the VA home loan. We are going to cut through the noise, bust the myths, and give you a crystal clear roadmap to understanding who is eligible for this incredible benefit. By the end of this, you won't just know if you're eligible. You'll understand why you're eligible, what that eligibility entitles you to, and how to take the first steps toward claiming the key to homeownership you've already earned. To truly understand this benefit, we have to go back in time. The year is 1944. Millions of American GIs are fighting across the globe in World War II. President Franklin D. Roosevelt and Congress are looking ahead, and they're worried. They remember the chaos after World War I, when veterans returned home to a weak economy, few jobs, and little support. They were determined not to let that happen again. So they passed a landmark piece of legislation, the Servicemen's Readjustment Act of 1944, better known as the GI Bill of Rights. The GI Bill was revolutionary. It provided tuition for college, unemployment benefits, and job counseling. But it also contained a groundbreaking provision for homeownership, the VA Loan Guarantee Program. The goal was to help returning heroes buy homes, start families, and build stable lives, preventing the economic and social upheaval of the past. It wasn't just a thank you. It was a strategic investment in the future of the nation, an engine for building the American middle class. And that promise, that legacy, is what we're talking about today. Now, let's get one of the biggest misconceptions out of the way immediately. This is critical to understand. The Department of Veterans Affairs, the VA, does not actually lend you the money. You don't go to a VA office and fill out a loan application. The VA isn't a bank. Instead, you get your loan from a private lender, a bank, a credit union, a mortgage company, just like anyone else buying a home. So, if the VA isn't lending the money, what exactly do they do? This is the secret sauce. The VA guarantees a portion of your loan. Think of the VA as the ultimate co-signer. They go to the lender with you and say, "Hey, we've got this veteran's back." They're a good risk. If, in a worst-case scenario, they can't make their payments and the loan goes into foreclosure, we, the U.S. government, will cover a portion of your losses. This government guarantee is a superpower. It completely changes the game for the lender. Suddenly, the loan becomes dramatically less risky for them. And because you are now a low-risk borrower in their eyes, the lender is willing to offer you incredible terms that just aren't available to the general public. This is where the famous benefits come from. First, the zero down payment. For a conventional loan, lenders typically want 20% down. If you don't have it, you're considered higher risk. But with the VA's guarantee, that risk is wiped away. The lender doesn't need a huge down payment as a security blanket, so in most cases, you don't need one at all. You can finance 100% of the home's value. Second, no private mortgage insurance or PMI. PMI is an extra monthly fee that conventional lenders charge borrowers who put down less than 20%. It's insurance that protects the lender, not you, in case you default. It can cost hundreds of dollars every month, and it does absolutely nothing to help you pay off your loan faster. With a VA loan, the government's guarantee serves the same purpose as PMI. It protects the lender. So, the requirement for that expensive monthly PMI is eliminated. This alone can save veterans tens of thousands of dollars over the life of their loan. And third, because the loan is less risky for the lender, they can offer more competitive interest rates. The VA also sets limits on what lenders can charge for closing costs, preventing veterans from being overcharged with junk fees. When you combine zero down, no PMI, and a great interest rate, you can see why this is the most powerful mortgage program in existence. So, the billion-dollar question, who gets to use it? Who is eligible? This is the core of what we're here to answer. Eligibility for the VA Home Loan Benefit is primarily determined by one thing: your military service. The VA has specific criteria to ensure the benefit goes to those who have served the nation. Broadly speaking, we can break down eligible individuals into two main groups: veterans and service members, and certain surviving spouses. Let's start with the largest group: veterans and service members. This category is incredibly broad and includes people from every branch of the service. We're talking about the Army, Navy, Air Force, Marine Corps, Space Force, and the Coast Guard. But it doesn't stop there. It also includes members of the Reserves and the National Guard. It covers those who are currently on active duty right now, as well as those who have served and separated. Whether you served for a few years or made a full career out of it, you may be eligible. The second group is a very special one: certain surviving spouses of service members who have passed away. This is a critical part of the VA's promise. The benefit doesn't necessarily die with the service member. If a veteran or service member died in service or from a service-connected disability, or was missing in action or a prisoner of war, their unmarried surviving spouse may be able to use the VA Home Loan Benefit. This is a lifeline that allows these families to achieve the dream of homeownership, even after an unthinkable loss. Now, simply being a veteran or a surviving spouse isn't quite enough. There's another layer we have to look at, and this is where people often get confused. It's called the minimum service requirement. The VA needs to see that you served for a specific length of time. This isn't just a blanket one-size-fits-all rule. The amount of time you needed to serve depends heavily on when you served. The rules for someone who served during World War II or Vietnam are different from the rules for someone who served during peacetime in the 1980s, which are different again for those who have served in the post-9/11 era. Did you serve on active duty? Were you in the National Guard or the Reserves? The requirements are different. Was it during a designated period of war or a period of peace? Again, the requirements change. This is the single most important detail in determining your eligibility, and it's precisely where we're going next. We need to break down these service eras from the greatest generation to the global war on terror, and show you exactly what the time and service requirements are for each one so you can pinpoint your own service history and know for certain if you qualify. Let's start at the very beginning, with the generation that this benefit was originally created for: World War II veterans. If you served on active duty anytime between September 16, 1940, and July 25, 1947, the requirement was straightforward. You needed at least 90 consecutive days of service. This was the original GI Bill promise. It was designed for the millions of soldiers, sailors, airmen, and Marines returning home, ready to trade their M1 Garands for hammers and build the American dream. This benefit literally built the suburbs. It transformed the landscape of our country, and it all started with that simple 90-day rule. Now, for every era we discuss, there's a critical exception to remember. If you were discharged for a service-connected disability, the minimum time in service requirement is waived. It doesn't matter if you served 89 days or 9 days. If your service led to a disability that cut your time short, you are eligible. That is a non-negotiable promise from the VA, and it applies across the board. Next, we move into the post-war era and the Korean War. This period covers service from July 26, 1947, all the way to January 31, 1955. For those who wore the uniform during this tense chapter of the Cold War, whether you were on the frozen hills of the chosen reservoir or standing guard in Germany, the requirement remained the same as the World War II generation. You needed at least 90 consecutive days of active duty service to qualify. The nation recognized that the threat to freedom didn't end in 1945, and so the promise of the VA home loan was extended to this new generation of veterans who answered the call. Then came one of the longest and most divisive conflicts in American history: the Vietnam War. For the purposes of VA loan eligibility, this era is defined as having served between August 5, 1964, and May 7, 1975. If you served in country, in the waters offshore, or anywhere else on active duty during this time frame, the requirement was once again 90 consecutive days. It's important to note that you did not have to serve in Vietnam itself. Your service anywhere in the world during this defined period counts. For those who served a bit earlier, in the period between the Korean and Vietnam Wars, from February 1, 1955 to August 4, 1964, the rules were slightly different. During this peacetime window, you needed 181 continuous days of active duty service. A subtle but important distinction. Following the Vietnam era, we entered a new phase with an all-volunteer force. This is where the eligibility requirements start to change significantly, and it's where many veterans serving from the late 70s through today need to pay close attention. Let's call this the post-Vietnam and Gulf War era. This period officially runs from May 8, 1975, all the way up to September 6, 1980. If you enlisted during this time, you generally needed 181 continuous days of active duty. However, a major shift happened for anyone whose service began after September 7, 1980, if you were an enlisted service member, or after October 16, 1981 if you were an officer. From this point forward, the standard requirement for active duty members became 24 continuous months of service. Think of it this way. The VA wanted to see that you had completed a full term of enlistment or a significant portion of your obligated service. So, if you signed a 4-year contract in 1985, you needed to have served at least 2 of those years to earn the benefit. But what about the Gulf War, also known as Desert Shield and Desert Storm? The VA established a specific wartime period for this conflict, running from August 2, 1990, through a date that is still technically open-ended. For anyone who served on active duty during this period, the requirement reverted back to the old wartime standard, just 90 days. So if you were called up for Desert Storm and served for 4 months, you are eligible. However, there's another critical rule for this modern era that you need to know. If you were called to active duty for a specific mission or period, you only needed to serve the full period for which you were called, as long as it was at least 90 days. For example, if your orders were for 120 days to support a specific operation and you completed that tour, you've met the requirement. The key takeaway for the modern all-volunteer force is this. The standard is 24 continuous months, unless you served during a designated wartime period like the Gulf War, in which case it drops back down to 90 days. This brings us to our most recent generation of service members, the post-9/11 and Global War on Terror veterans. If your service began after September 7, 1980, and you've been serving in the years since the attacks of September 11, 2001, the rules are the same as the Gulf War era. The standard requirement is 24 continuous months of active duty service. However, because this is a designated wartime period, if you served on active duty for at least 90 consecutive days, you meet the time and service requirement. This covers millions of veterans who have deployed to Iraq, Afghanistan, and countless other locations around the globe in the last 2 decades. Whether you did a full 20-year career or a single 4-year enlistment, the path to eligibility is clear. 24 months of regular service, or just 90 days if your service falls within this wartime period. And again, that all-important exception always applies. If you were medically discharged for a service-connected disability, you are eligible, period. Now, I know what a huge portion of you are thinking. What about the Guard and Reserve? This is one of the most common areas of confusion, and the answer is yes, you are absolutely eligible, but your path is different. For members of the National Guard and the Reserves, your eligibility isn't primarily based on days or months, but on years. The standard requirement is 6 years of creditable service in the selected reserve or guard. You have to complete a full 6 years and receive an honorable discharge. At the end of that 6 years, you have earned the VA Home Loan benefit for life. However, there's a massive exception here too, and it's one that applies to tens of thousands of Guard and Reserve members since 9/11. If you were called up to active duty under federal orders, that's Title 10 or Title 32 orders, the rules change. Once you are federally activated, you are now under the same rules as the active component. This means you only need to serve 90 consecutive days on federal active duty to gain eligibility. So if your Guard unit was activated and deployed to Iraq for a year, you became eligible for the VA loan after your first 90 days on that deployment. You don't have to wait the full 6 years. This single rule has opened the door to homeownership for countless citizen soldiers and airmen who have sacrificed so much over the last 20 years. So, let's quickly recap the core requirements. For wartime service, that's World War II, Korea, Vietnam, the Gulf War, and the post-9/11 era, you generally need 90 days of active service. For peacetime service, it's typically 181 days or, for the modern era, 24 continuous months. And for the Guard and Reserves, it's 6 creditable years unless you're activated for federal service, then it's just 90 days. And for everyone, the golden ticket that overrides all of these time requirements is a discharge for a service-connected disability. Now that you've likely pinpointed your service era and confirmed you meet the time and service requirement, the next step is proving it to the VA. And that brings us to the single most important document in the entire VA loan process, the Certificate of Eligibility, or COE. In the next part, we're going to show you exactly what it is, why you need it, and the 3 different ways you can get your hands on it, sometimes in a matter of minutes. So, what exactly is this document? Think of the Certificate of Eligibility, the COE, as the golden ticket. It's not the loan itself. It's not a guarantee you'll be approved for a mortgage. Instead, it's the official stamp from the Department of Veterans Affairs that says one simple, powerful thing. Yes, this person has served. They have met the minimum requirements to be considered for the VA home loan benefit they earned. Without this piece of paper, or more accurately, this digital confirmation, a lender can't even begin to process your VA loan application. It's the key that unlocks the entire process. But why is it so important? Why does a lender, who is the one giving you hundreds of thousands of dollars, care so much about a document from the VA? It all comes down to one word: entitlement. The COE is the document that officially states your VA loan entitlement. Now, entitlement is one of those government words that can sound a little confusing, but the concept is actually pretty straightforward. It's the amount of money that the VA promises to repay your lender if, for some catastrophic reason, you default on your loan. Your basic entitlement is $36,000. Now, you're probably thinking, $36,000? What kind of house can I buy with that? And that's the critical point. You're not borrowing $36,000 from the VA. That number is a guarantee to your lender. Because the VA typically guarantees a quarter of the loan amount, that $36,000 guarantee from the VA gives a private lender the confidence to loan you 4 times that amount, $144,000, often with no down payment required. And in most parts of the country today, that $36,000 is just the beginning. There's a second layer of entitlement, often called bonus or Tier 2 entitlement, that allows veterans to get loans for $500,000, $600,000, $700,000 or more, still with 0 down payment. The Certificate of Eligibility is the official proof that you have this entitlement, this powerful government backing that makes you one of the most attractive and low-risk borrowers a lender can find. It's the evidence that you hold the power of the VA guarantee. So, the mission is clear: you need to get your COE. The good news is what used to be a frustrating mail-in and wait process can now happen in literally seconds. Let's break down the 3 primary ways to get it, starting with the old-school method. Method number 1. Requesting your COE by mail. Picture this: you're printing out a government form, digging through an old footlocker for your discharge papers, putting it all in a manila envelope, and sending it off to the VA, hoping for the best. This is, without a doubt, the slowest and most cumbersome way to get your certificate. You'll need to fill out VA Form 26 to 1880, the request for a Certificate of Eligibility. You'll also need to provide proof of your service. For most veterans, this means your DD Form 214, the Certificate of Release or Discharge from Active Duty. If you're still on active duty, you'll need a statement of service signed by your commander or personnel officer. For members of the National Guard or Reserves, it's a bit different. You'll need your NGB Form 22 or 23, or an annual point statement. And for surviving spouses, you'll generally need the Veteran's D-214 and a copy of your marriage certificate, along with the Veteran's Death Certificate. You gather all this, mail it in, and you wait. And wait. This process can take weeks, sometimes even a month or more, depending on the VA's workload. In today's fast-moving housing market, that kind of delay can be a deal killer. We consider this the method of last resort. Luckily, there's a much better way. Method number 2. Getting your COE online yourself. The VA has made huge strides in digitizing its services. You can go directly to the VA.gov website or the Oldie Benefits portal, log in with your credentials, and request your COE electronically. If all of your service information is perfectly updated in the VA system, this can be an amazing experience. You click a few buttons and bam! A PDF of your Certificate of Eligibility is generated instantly. You can download it, save it, and you're ready to go. It's fast, it's direct, and it puts you in control. However, it's not always that simple. Sometimes the system can't automatically verify your eligibility. You might get a message saying that your request needs further review, or that you need to upload your proof of service documents, like that DD-214. It's still much faster than mailing, but it can sometimes hit a snag that requires a bit more work on your end. This brings us to the third, and by far the easiest and most recommended method. Let your lender get it for you. This is the pro move. This is how the vast majority of VA loans get started today. Any experienced, VA-savvy lender has direct, electronic access to the VA system through a portal called WebLGY. Think of it like a special express lane to the VA that only approved lenders can use. All you have to do is provide your lender with your full name, date of birth, and social security number. That's it. They plug that information into the WebLGY system, and in over 90% of cases, the Certificate of Eligibility is generated and returned to them in less than a minute. We're talking seconds. You can be on the phone with a loan officer, and before you've even finished explaining your situation, they can say, "Okay, got it. Your COE is here." It is by far the most efficient, painless, and reliable way to get this done. And what if you're in that small percentage where the system can't issue it instantly? Still the best option. The system will give the lender a specific reason why it couldn't be issued automatically. Usually it just needs proof of service. So the lender will simply tell you, "Hey, the VA needs a copy of your D-214. You can then securely upload or email it directly to them. They'll submit it through the same WebLGY portal. And the issue is typically resolved in just a few business days, not weeks or months. This single step, letting a qualified lender pull your COE for you, can save you an immense amount of time, stress, and potential heartache. Now, once you have your COE, whether you got it yourself or through your lender, you need to know what you're looking at. Two things are incredibly important. First, look for a line that mentions your funding fee status. If you receive VA disability compensation, you are exempt from paying the VA funding fee, a closing cost that can save you thousands or even tens of thousands of dollars on your loan. Your COE is the official document that will state exempt. If it says NON exempt, and you believe that's wrong, you need to address it immediately. Second, you'll see your entitlement code. This code, usually a 2-digit number, tells the lender under which period of service you qualified. For example, Code 10 is for World War II, while Code 05 is for the post-Vietnam era. It's just a way for the VA to categorize your eligibility. The most important thing to remember is that the Certificate of Eligibility is your starting block. It's the first concrete step in your home buying journey. It's the proof that you've earned this incredible benefit and are eligible to use it. It's not a hurdle to be feared. It's a gateway to be opened. And now you know that with the right partner, you can open that gate in a matter of minutes. So now you have your Certificate of Eligibility. It's in your hand, and it says you have entitlement. But what in the world does that even mean? How does a number like $36,000 on a piece of paper translate into a $500,000 home loan with zero down payment? That's the magic we're breaking down next. We're going to demystify VA loan entitlement, explain how it actually works, and reveal how you might have far more buying power than you ever imagined. Let's talk about the single most misunderstood word in the entire VA loan process: entitlement. The word itself feels a little strange, doesn't it? It sounds like you're being given a handout, something you didn't earn. But I want you to erase that definition from your mind right now. When it comes to the VA loan, entitlement doesn't mean a handout. It means a promise. It is a solemn promise from the United States government to the lending institution, a guarantee that you have earned through your service. Think of it this way. You walk into a bank and ask for a massive loan to buy a house. The bank is nervous. They don't know you. They see risk. But then the VA steps in, puts a hand on your shoulder, and looks the banker dead in the eye. The VA says, "We know this person. They served. We vouch for them. If for some reason they can't make their payments and this loan goes bad, we will cover a portion of your losses." Suddenly, the bank's entire perspective changes. The risk evaporates. They see you not as a risk, but as a secure investment backed by the full faith and credit of the US government. That promise, that guarantee, is your entitlement. It's not a check written to you. It's a multi-$100,000 vote of confidence written to your lender. And it's the reason they'll give you a loan with zero down payment and incredible interest rates. So, how much is this promise worth? This is where the numbers come in, and it's where most people get lost, so stick with me. Every eligible veteran starts with what's called basic entitlement. The number you'll see everywhere is $36,000. And I know what you're thinking. $36,000? I can't even buy a decent truck for that, let alone a house. And you're absolutely right. But remember that $36,000 isn't the loan amount. It's the amount of the guarantee. Historically, the VA guarantees up to 25% of the loan amount. So lenders, being smart about their risk, just did the math. They said, if the VA is guaranteeing $36,000, and that represents 25% of the loan, then we can safely lend 4 times that amount. $36,000 times 4 is $144,000. For decades, this was the unofficial cap on a zero-down VA loan. If you wanted to buy a more expensive house, you had to put down 25% of the difference. But let's be honest, in today's market, $144,000 barely gets you a down payment in some cities. This is where the old rules would have stopped you cold. But the game has completely changed. That $36,000 is now just the beginning of the story. It's your entry ticket. The real power comes from something called bonus entitlement, sometimes called Tier 2 entitlement. This is the key that unlocks that $500,000 or even $1 million home with zero down. Thanks to a major law change a few years ago, for a veteran with their full entitlement, the VA no longer sets a loan limit. Let me say that again because it is the most important sentence you might hear today. If you have your full entitlement, there is no official VA loan limit. Your limit is not set by the VA. It's set by your lender. It's based on what you can realistically afford: your income, your credit score, your debt. So if your lender qualifies you for a $700,000 home, you can buy that home with a VA loan and put $0 down. So the next logical question is, do I have my full entitlement? It's simple. You have your full entitlement if one of two things is true. One, you have never ever used your VA home loan benefit before. Or two, you have used it in the past, but you sold the property, paid the loan off in full, and went through a simple process called restoration to get your full entitlement back. If you fall into either of those two categories, congratulations. Your buying power is limited only by your financial profile. But what if that's not you? What if you're one of the thousands of service members or veterans who used the VA loan to buy a small condo at your first duty station years ago, and you still own it? Maybe you rent it out now. Or what if, and this is a tough but important situation, you had a VA loan in the past that ended in foreclosure? You might think your benefit is gone forever. You might think you're out of the game. You're not. This is where bonus entitlement becomes your superpower. You don't have your full entitlement, but you have remaining entitlement. And that remaining entitlement can still be enough to buy another, often much larger, home with zero down payment. Let's walk through an example. Let's imagine a staff sergeant, we'll call her Sarah. 10 years ago, Sarah bought a small townhouse near Fort Hood for $200,000 using her VA loan. She now has orders to move to a new base near Denver, where homes are much more expensive. She wants to keep her Texas townhouse as a rental property for extra income. She thinks she can't use her VA loan again because it's tied up in that first house. Here's how we figure out Sarah's true buying power. First, we calculate how much of her entitlement she used on that first home. The loan was for $200,000. The VA guaranteed 25% of that, which is $50,000. So Sarah has used $50,000 of her entitlement. Now we need a second number. It's called the conforming loan limit, and it's set by the federal government every year. It varies by county, but for our example, let's use the national baseline, which is currently $766,550. The VA uses this number and says, we will guarantee up to 25% of this limit for a veteran, even if they've used the benefit before. Okay, let's do the math. 25% of that big number, $766,550, is roughly $191,600. This is the VA's total potential promise for Sarah. We know she already used $50,000 of that promise on her Texas home. So, we subtract what she used from the total potential promise. $191,600 minus $50,000 equals $141,600. That number, $141,600, is Sarah's remaining entitlement. That is the amount of additional guarantee the VA is willing to make for her. And just like before, a lender will typically be comfortable lending 4 times that amount. So we take her remaining entitlement, $141,600, and multiply it by 4. The result is $566,400. That is the amount for a second VA loan that Sarah can take out to buy a home in Denver, with absolutely zero money down, all while still owning her first home in Texas. She went from thinking she was tapped out to realizing she has over $500,000 in zero down buying power. This is not a loophole. This is not a trick. This is the designed purpose of the modern VA loan. It's a benefit that grows with you in your career. The same principle applies even in a difficult situation like a foreclosure. You lose the entitlement that was tied to that foreclosed loan, but your bonus entitlement, the amount up to that county loan limit, is still there for you to use in the future once you've reestablished your credit. It is a resilient benefit designed to help you recover and succeed. So let's recap the magic. Entitlement is not cash. It's the VA's promise to your lender. If you have your full entitlement, your zero-down buying power is essentially unlimited, determined only by your finances. If you've already used part of your benefit, you have remaining entitlement, which you can calculate using the county loan limit to determine exactly how much you can borrow for your next home with zero down. It is a reusable, flexible, and incredibly powerful tool that you have earned. Now you understand the power you hold with your VA entitlement. You know the promise that's backing you. But there's a crucial piece of paper, a document that acts as the key to unlock this entire process. Without it, a lender won't even start the application. It's your golden ticket. It's called the Certificate of Eligibility, or COE. And how you get that certificate, what it says, and what to do if you have trouble finding it, is the essential next step we're breaking down. So let's talk about this golden ticket. The Certificate of Eligibility, or COE, is the VA's official declaration to the lender that says, yes, this person has met the minimum service requirements to be eligible for this benefit. It's the proof. It's the document that separates the dreamers from the doers. Without it, a lender can't even order the VA appraisal. It's the absolute, non-negotiable first piece of the puzzle. Now, getting it can be incredibly simple, or it can feel like a bureaucratic nightmare. The difference often comes down to knowing your options. And you have three primary ways to get your hands on this critical document. The first, and by far the most common and recommended method, is to let your lender get it for you. A good, experienced VA-approved lender has direct access to the VA system, a portal called WebLGY. For probably 90% of veterans and service members, the lender can input your information, your name, social security number, date of birth, and have your COE back in a matter of seconds. Seconds. It's the easy button. This is the path of least resistance. You don't have to fill out forms, you don't have to dig through old files, you just provide your basic info to a professional who does this every single day, and poof, the document appears. This is why we always say the first step isn't finding a house, it's finding a great lender. They become your guide. And this is their first opportunity to prove their worth by making your life easier. But maybe you're a do-it-yourself kind of person. Maybe you want to have all your ducks in a row before you even speak to a lender. Or maybe for some reason the lender's automated system can't find you. This brings us to option 2. Getting the COE yourself online. You can do this through the VA's e-benefits portal. You'll need to have an account, which might require a bit of setup if you don't already have one. Once you're logged in, you can navigate to the home loan section and apply for a COE electronically. The system will guide you through the process, and you'll likely have to upload your proof of service. If your records are straightforward and already digitized in the VA system, this can also be incredibly fast. You might get an instant result. However, if the system needs to do a little more digging, it could take a few days for them to process your request and make the COE available for download. This method gives you control, but it also puts the responsibility squarely on your shoulders. The third option is the old-school way. Applying by mail. This is your last resort. This is the path you take if the other two options fail, or if you simply don't have access to or comfort with using the internet. You would fill out VA Form 26 to 1880, the request for a Certificate of Eligibility. You'll mail this form, along with your proof of service documents, to the VA Regional Loan Center that handles your state. And then you wait. Mail-in requests are processed in the order they're received, and this can take several weeks. In a fast-moving real estate market, weeks can feel like an eternity. A deal on a house you love can be gone in a weekend. So while this option exists, it should be avoided unless absolutely necessary, because it introduces significant delays into your home buying timeline. Now, I've mentioned proof of service a few times. This is the most important part of the COE request, and what you need depends on your status. For most veterans, this is your DD Form 214, the Certificate of Release or Discharge from Active Duty. Specifically, you want the Member 4 or long form copy, as it contains the character of your service. If you are still on active duty, you don't have a DD 214 yet. Instead, you'll need a Statement of Service. This is a document prepared on official military letterhead, signed by your commander, adjutant, or personnel officer. It needs to show your full name, social security number, date of birth, the date you entered service, your current rank, and any lost time. Crucially, it must state that you are on active duty and it must be signed. For members of the National Guard or Reserves, it's a bit different. You'll need your annual retirement point statement, often called an NGB Form 23 for the Army National Guard or an AF Form 526 for the Air National Guard, along with proof of your honorable service. You need to show that you've completed the required 6 years of creditable service. So you get the COE. What are you actually looking at? It's not just a pass/fail document. It contains vital information that your lender needs to structure your loan correctly. First, look for your name and social security number to make sure they're correct. Simple but critical. Next, you'll see an entitlement code. This is a number from 01 to 11 that tells the lender under which period of service you qualified. For example, Code 10 often signifies post-Vietnam era service, while Code 05 could be for a veteran who served during the Korean War. This code helps the lender verify your eligibility. The most important section, however, is the one that details your entitlement. It will say you have basic entitlement of $36,000. Now don't panic. That is not the maximum you can borrow. It's a number the VA uses in its calculation to guarantee a portion of your loan to the lender. The COE will also state whether you have full entitlement, or if your entitlement is reduced because you've used the VA loan before and haven't fully restored it. We'll dive deep into what entitlement really means and how it calculates your true zero down payment purchasing power in a later part, but for now, just know that your COE is where this information lives. There's one other piece of information on that COE that can save you thousands of dollars. It's your funding fee status. The VA funding fee is a one-time cost rolled into most VA loans. However, if you are a veteran receiving VA disability compensation, or a surviving spouse of a veteran who died in service or from a service-connected disability, you are exempt from paying this fee. Your COE should explicitly state exempt in the funding fee section. If you believe you should be exempt but your COE doesn't say so, you need to get that corrected immediately before you close on your loan. This isn't something that can be easily refunded later. It's a box that must be checked up front, and your COE is the proof. But what if you hit a wall? What if your lender tries to pull your COE and gets an error? What if you apply online and the VA says they have no record of you? Don't panic. This happens more often than you'd think, especially for older veterans whose records may not be fully digitized, or for Guard and Reserve members whose paperwork can be more complex. I worked with a Vietnam veteran whose service records were lost in the massive 1973 fire at the National Personnel Records Center in St. Louis. The VA's automated system had nothing on him. For him, the dream of using his VA loan benefit felt like it was turning to ash just like those records. But there is always a path forward. This is where you have to become a detective. You start gathering secondary evidence. Old pay stubs, military orders, award citations, letters from buddies you served with. You work with the National Archives to reconstruct your service history. You submit this evidence to the VA along with your application. It's not a fast process, but it's a possible one. In that veteran's case, it took nearly 2 months of dedicated work, but we were able to piece together enough proof for the VA to manually issue his Certificate of Eligibility. He held that piece of paper in his hand like it was a Medal of Honor. It was a testament not just to his service decades ago, but to his perseverance in the present. So if your record doesn't pop up instantly, it is not a no. It's just a not yet. It means you have to move on to the next step of providing the documentation manually. The bottom line is this. The Certificate of Eligibility is your official entry pass to the VA Home Loan Benefit. While a great lender can often get it for you in seconds, it's crucial for you to understand what it is, what it says, and what to do if there's a problem. Getting this document is your first major victory in the home buying journey. It transforms your eligibility from a theoretical concept into a tangible asset. And with that golden ticket finally in your hand, you're ready to take on the next and equally important part of the process. Proving to the lender that you not only have the eligibility, but also the financial stability to take on a mortgage. That means we have to talk about credit and income. So you've navigated the maze of service requirements and you're holding that golden ticket. The Certificate of Eligibility. You've earned it. Every single day of your service, every sacrifice has led to this moment. And there's this feeling, this powerful assumption that the hardest part is over. You walk into a lender's office thinking, I've served my country, I have my seat, let's do this. But then you're hit with a whole new set of questions, a different kind of scrutiny. Suddenly, the conversation isn't about your DD-214. It's about FICO scores, debt-to-income ratios, and something called residual income. This is the moment many veterans get blindsided. Because having the eligibility for the benefit and qualifying for the loan are two separate missions. The COE gets you in the door. Your financial profile gets you the keys. Let's start with the biggest myth in the entire VA loan universe: the credit score. If you've been on any forum or talked to a buddy, you've probably heard that the VA requires a specific minimum credit score. Let me be crystal clear. That is completely false. The Department of Veterans Affairs does not set a minimum credit score. You will not find a rule in any VA handbook that says you need a 620, a 640, or any other number to use your benefit. The VA's perspective is holistic. They look at the entire picture of your finances. They believe that one three-digit number doesn't define a veteran's ability to be a homeowner. So if the VA doesn't have a minimum, why is every lender you talk to asking about your score? The answer is a simple but crucial concept called lender overlays. Think of it this way: the VA is like the league that sets the rules for the game. They say, okay, for this game, there's no down payment required and no private mortgage insurance. They create the framework. But the lender is the team that actually has to put up the money. They are the ones taking on the financial risk. So while they have to play by the VA's rules, they're allowed to add their own, more conservative safety guidelines on top. These extra rules are overlays. And the most common overlay by far is a minimum credit score requirement. The lender is essentially saying, we love the VA program, but to protect our investment, we want to see a track record of on-time payments, which is what a credit score represents. It's not the VA denying you. It's the private lender making a business decision. So what's the magic number? While it varies from lender to lender and can change with the economy, most VA lenders today are looking for a FICO score of around 620 or higher. Some might be a bit more flexible, some a bit more strict. But 620 is a very common benchmark. Now, if your score is below that, do not panic and do not give up. It doesn't mean you can never use your VA loan. It just means you have a new mission: improve that score. A lower score is a yellow flag for lenders, not a red one. It might mean they look more closely at other parts of your file, or it could result in a slightly higher interest rate. The key is to shop around. One lender might say no, while another, who specializes in working with veterans with challenging credit, might have a program to help you get there or approve you as is. Your credit score isn't a grade on a test you pass or fail. It's a financial handshake. It's the first impression you give a lender that you can be trusted to handle debt responsibly. If your handshake is a little weak, you can strengthen it. The fastest ways? Pay down your credit card balances. Lenders look closely at your credit utilization, how much you owe versus your total limit. Getting that number below 30% can give your score a significant boost in a short amount of time. And of course, pull your credit report. Look for errors. A mistake in your file could be unfairly dragging you down. Correcting it is your right, and it could be your ticket to approval. But let's say your credit is great. You've got a 750 score. You're still not at the finish line. A great credit score tells the lender you are willing to pay your bills on time. The next part of the equation, income, proves that you are able to. This is where the lender's underwriting department puts on their green eye shades and really starts digging into your finances. They need to be confident that you have a stable, reliable, and sufficient income to handle not just the new mortgage payment, but all of your other life expenses too. For VA loans, this analysis is a two-pronged attack. They look at your debt-to-income ratio, or DTI, and your residual income. First, DTI. This is a concept used in almost all mortgage lending. It's pretty simple. The lender adds up all of your monthly debt payments, things like a car loan, student loans, credit card minimum payments, and the estimated new mortgage payment, including taxes and insurance. Then they divide that total by your gross monthly income before taxes. The result is your DTI ratio. For example, if your total monthly debts are $2,000 and your gross monthly income is $5,000, your DTI is 40%. The VA generally likes to see a DTI of 41% or less. This is a guideline, a comfort zone for them. It suggests that less than half of your pre-tax income is going toward debt, leaving a healthy amount for taxes, food, utilities, and everything else. But here's where the VA loan begins to show its true power and flexibility. That 41% is not a hard, immovable line in the sand. I have seen VA loans approved with DTIs of 50%, 55%, or even higher. How is that possible? It's because of the VA's second, and arguably more important measurement, residual income. Residual income is the VA's secret weapon. It's a unique feature of the program designed with one purpose: to protect veterans from foreclosure. While DTI is a ratio, a percentage, residual income is about cold, hard cash. It's the amount of money you have left over each month after you pay every single one of your major obligations. The new mortgage, your debts, estimated utilities, and federal and state taxes. It's your net discretionary income, your life happens fund. The VA understands that a 41% DTI means very different things for different families in different parts of the country. A single service member in a low-cost state like Alabama could live very comfortably with a 50% DTI. But a family of 5 in a high-cost area like San Diego might be struggling even with a 35% DTI. The VA gets this. They have a table that sets a minimum required residual income based on your family size and the region of the country you live in. For example, in 2023, a family of 4 in the Northeast might need to have at least $1,039 left over each month, while the same family in the Midwest might need $1,003. This residual income calculation is what gives lenders the confidence to sometimes approve a loan with a DTI above that 41% guideline. If your DTI is, say, 48%, but your residual income is significantly higher than the minimum required for your family and region, the lender can see that you still have plenty of cash flow to live comfortably. You are not house poor. You have a buffer. This common-sense approach is one of the single greatest advantages of the VA loan. It looks at your real-world financial situation, not just a number on a spreadsheet. So what counts as stable and reliable income? For active duty military, it's straightforward. Your base pay, your basic allowance for housing BAH, basic allowance for subsistence BAS, and other specialty pays all count. For veterans, it can be a salary from a civilian job, retirement pay, or VA disability compensation. It's important to know that VA disability income is non-taxable, so lenders can gross it up, typically by 25%. Meaning they count it as a larger number since no taxes are taken out. This can significantly help your DTI. If you have part-time, commission-based, or self-employment income, lenders will typically want to see a 2-year history of you earning that income to consider it stable. The same goes for a spouse's income. If you're using it to qualify, the lender will verify it just as thoroughly as yours. The key word is always consistency. You have to prove that the money coming in is a reliable stream, not a temporary flood. So the journey from seed to closing day runs directly through this financial gauntlet. Your credit report tells the story of your past financial habits, while your income and assets tell the story of your present financial strength. The VA loan program, with its unique emphasis on residual income, provides a flexible and common-sense path. But it's a path you must be prepared for. You've proven you can serve. Now you have to prove you can sustain. Now that you understand the financial qualifications, the credit and income checks you'll need to pass, a new, more exciting question emerges. Okay, I think I qualify. But what kind of home can I actually get? Can I buy a condo? A multi-unit property? What about a fixer-upper? That's where we get into the really fun stuff, the property requirements and the surprising things you can and absolutely cannot buy with a VA loan. And trust me, some of the answers will definitely surprise you. So let's dive right in. You've found a house you love. It's in the right neighborhood, it has the perfect backyard, but it's a little unique. Maybe it's a duplex, and you're thinking about living in one side and renting out the other. Maybe it's a condo in that high-rise downtown. Or maybe it's a charming old farmhouse that needs a little bit of love. The single biggest question that trips people up isn't about their own eligibility. It's about the property's eligibility. The VA isn't just backing you, the borrower. They're also backing the property. And because of that, they have a set of standards designed for one primary reason: to protect you. They don't want you, a veteran, using your hard-earned benefit to buy a money pit or worse, a home that's unsafe. These standards are called the Minimum Property Requirements, or MPRs. And while that sounds like a bunch of bureaucratic red tape, I want you to reframe it. Think of the MPRs as your built-in expert-level home inspection, a safety net that a conventional loan just doesn't have. To make it simple, you can boil down all the dozens of MPRs into 3 core principles. The property must be safe, sound, and sanitary. Let's call them the 3 S's of a VA-approved home. First, let's talk about safe. This is the most important one. The VA appraiser is trained to look for anything that could pose a hazard to you and your family. We're talking about things like peeling or chipping lead-based paint in a home built before 1978. We're talking about exposed electrical wiring, a lack of handrails on staircases, or a heating system that isn't working properly and safely. They'll check to make sure the house has adequate heating to maintain a temperature of at least 50 degrees Fahrenheit. They're looking for anything that could cause immediate harm. This isn't about aesthetics. It's about life and safety. The VA's perspective is simple. A benefit designed to help you shouldn't put you in harm's way. Next, the property must be sound. This is all about structural integrity. Is the foundation solid without major cracks or signs of settling that could spell disaster down the road? Is the roof in good condition, with enough life left in it to not require an immediate $10,000 replacement? The appraiser will look for evidence of termite damage, wood rot, and water damage. They'll check to make sure there's proper drainage so water flows away from the house, not into your basement. A house that isn't structurally sound isn't an asset. It's a liability waiting to happen. The VA wants to ensure your home is a blessing, not a financial curse. Finally, the home must be sanitary. This means it has to be livable from day one. It needs a reliable supply of safe drinking water. That could be from a public utility or a private well. But if it's a well, it has to be tested to make sure the water is safe to drink. It needs a working legal sewage disposal system, whether that's a connection to the city sewer or a functioning septic tank. The home must have a working bathroom with a toilet, sink, and shower or bath. It needs adequate space for living, sleeping, and cooking. This doesn't mean it has to be a palace. It just means it has to meet a basic standard of modern sanitary living. Now, the person who makes this call is the VA certified appraiser. And this is a critical distinction. In a conventional loan, an appraiser's main job is to determine the home's value. For a VA loan, the appraiser has two jobs: determine the value and ensure the property meets all the minimum property requirements. They are your eyes and ears, looking out for your best interests. So what happens if the appraiser finds something? What if they say the roof is shot or the water heater is on its last legs? Does that kill the deal? Not usually. This is actually where the NPRs become a powerful negotiation tool. The appraiser will note the issues in their report, and the loan can't close until they're fixed. This gives you three primary options. 1. The seller can agree to make the repairs before closing. This is the most common outcome. The seller wants to sell the house, you want to buy it, and fixing a leaky faucet or replacing a broken window is usually a small price to pay. 2. You can walk away. If the seller refuses to make the repairs and the issues are too big for you to handle, your VA loan contingency often allows you to cancel the contract and get your earnest money back. The NPRs just saved you from a nightmare. Or 3, and this is less common, you might be able to pay for the repairs yourself, but this can be tricky and depends heavily on your lender. The key takeaway is that a failed NPR inspection isn't a dead end. It's a fork in the road that protects you from making a bad choice. Okay, so that covers the basics. But what about those surprising properties we talked about? This is where the VA loan benefit truly shines. Let's start with the biggest one: multifamily homes. Can you buy a duplex, a triplex, or even a fourplex with a VA loan? Absolutely yes. With zero down payment. This is arguably the single most powerful and most underutilized feature of the VA loan. The only major rule is that you, the veteran, must intend to occupy one of the units as your primary residence. Think about that. You could buy a 4-unit property, live in one unit, and have the rent from the other 3 units pay your entire mortgage, and maybe even put cash in your pocket every month. This strategy, known as house hacking, is a phenomenal way to build wealth, and the VA loan makes it accessible to those who might never qualify for a conventional investment property loan. What about condos? Yes again, but with a crucial catch. The entire condominium complex must be on the VA's approved list. Why? Because when you buy a condo, you're not just buying your unit. You're buying into a shared ownership structure with the Homeowners Association, or HOA. The VA wants to make sure the HOA is financially stable, has adequate insurance, and doesn't have crazy rules that could jeopardize your ownership. You can search for VA-approved condo complexes directly on the VA's website, and your real estate agent should be an expert at helping you navigate this. How about manufactured homes? This is a common myth. Many people think you can't buy a manufactured or mobile home with a VA loan. That's false. You absolutely can, but there are strict requirements. It must be permanently affixed to a foundation, it must be properly titled as real property, not personal property like a vehicle, and it has to meet specific HUD safety standards. So, a trailer in a park won't work, but a modern manufactured home on its own piece of land? That is very much a possibility. Now for the flip side. What can you absolutely not buy? The big one is a major fixer-upper. A home being sold as is that has a leaky roof, a broken furnace, and holes in the floor will not pass the NPRs. The standard VA loan is for a home that is move-in ready, one that is safe, sound, and sanitary right now. But what if you're handy and you dream of turning a diamond in the rough into your perfect home? Don't lose hope because the VA does have a special tool for that, but we'll get to that in a bit. You also can't use a VA loan to buy a property that is purely a business. You can't buy a standalone barber shop or an office building. The loan's purpose is for a primary residence. However, there's a gray area with mixed-use properties. If you find a property that is, say, a two-story building with a small, empty storefront on the ground floor and a residential apartment upstairs where you'll live, it might be possible. But it's complex and the property's value and floor space must be primarily residential. And finally, things that aren't considered real estate are out. This means no houseboats, no RVs, and no tiny homes on wheels. The key is the permanent foundation. If you can drive it away, you can't get a VA home loan for it. Similarly, a working farm or ranch purchase for its business income is a no-go. But you can buy a home on a large piece of land, even 10, 20 or more acres, with a barn and outbuildings, as long as the appraiser determines the value is primarily in the home itself, not in the land's agricultural business potential. So the property requirements aren't there to stop you. They're there to guide you. They ensure that the home you buy with your VA benefit is a solid, safe investment for you and your family. The VA acts as your partner, your advocate, looking out for you every step of the way. So we know who is eligible and we now know what kind of house you can buy. But this all leads to the biggest question of all, the one that determines everything. How much house can you actually afford? What are the VA loan limits? Is it true you can get a VA loan for $1 million? Or even more? With zero down? The answer to that question has changed dramatically in recent years, and it's the single biggest myth we need to bust. And that's exactly what we're breaking down next. For decades, the answer was a hard no. The idea of $1 million VA loan with no money down sounded like a fantasy. There were hard caps, strict limits set by the government, that dictated the maximum amount you could borrow before you had to start reaching into your own pocket for a down payment. If you wanted to buy a home in San Diego or Northern Virginia or Honolulu, you were often out of luck unless you had significant savings. The VA loan, a benefit earned through service, was paradoxically locking veterans out of the most competitive housing markets in the country. But that all changed. And the key to understanding this massive shift lies in a single term: entitlement. See, the old system was tied to something called the conforming loan limit. These are the limits set by the Federal Housing Finance Agency for loans that can be bought by Fannie Mae and Freddie Mac. For years, the VA tied its zero down payment guarantee to these very same limits. In 2024, for most of the country, that limit is $766,550. In more expensive areas, it can be higher, over $1 million. Under the old rules, if you were a veteran with your full VA loan entitlement, you could borrow up to that county-specific limit with zero money down. But the second you wanted to buy a house for $1 over that limit, you had to start paying. Specifically, you had to put down 25% of the difference. So, if the limit was $700,000 and you wanted to buy a $750,000 house, you'd need a down payment of $12,500, 25% of that $50,000 difference. This was the ceiling. It was a barrier that kept countless military families from buying the right home for them in the community they wanted to live in. Then everything was turned on its head. On January 1, 2020, thanks to the Blue Water Navy Vietnam Veterans Act, this ceiling was effectively shattered. While the law's main purpose was to provide benefits to veterans exposed to Agent Orange, it included a provision that completely revolutionized VA home loans. Here is the new reality, the single most important thing to understand about this topic. If you are a veteran with your full, unencumbered VA loan entitlement, there is no longer a VA-imposed limit on the size of the loan you can get with zero money down. Let me say that again because it's a concept that is still so widely misunderstood. For veterans with full entitlement, the VA loan limit is gone. It does not exist. The limit is no longer what the government says it is. The limit is what the lender says you can afford. If a lender, based on your income, your credit score, and your debt-to-income ratio determines you can afford a $1.5 million home, you can buy that $1.5 million home with a VA loan and put $0 down. The VA will guarantee that loan. This is a seismic shift. It means that veterans are no longer at a disadvantage in America's most expensive cities. They can compete on a level playing field. The dream of homeownership is no longer capped by an arbitrary number. So, who has this full entitlement? It's simpler than it sounds. You have your full entitlement if you meet any of these conditions. You've never used your VA home loan benefit before. Or, you've used it but you paid the loan back in full and sold the property. Or, you've used it and another qualified veteran formally assumed your loan. In any of these cases, your entitlement is fully restored, and you have access to this no-limit benefit. But what if that's not you? What if you already have an active VA loan? What if you're looking to buy a second home, perhaps after a PCS move, and you've decided to rent out your first property instead of selling it? This is where the old rules, the conforming loan limits, still come into play. This is the world of remaining entitlement or partial entitlement. This is where things can get a little tricky, but stick with me because understanding this calculation is like having a financial superpower. It can unlock opportunities you never thought possible. First, remember that the VA doesn't lend you the money. The bank does. The VA simply guarantees a portion of that loan, specifically 25%. This guarantee is what gives the bank the confidence to lend you money with zero down payment and great interest rates. So, when we talk about your entitlement, we're really talking about the amount the VA is willing to guarantee for you. Your basic entitlement is $36,000. But there's also a second layer, called bonus or secondary entitlement, which brings the total amount the VA will guarantee up to 25% of the conforming loan limit in your county. Let's use that 2024 conforming limit of $766,550. 25% of that is $191,637.50. This is the total amount of guarantee the VA has on deck for you. Now, let's say you bought a home a few years ago for $200,000 using your VA loan, and you still own it. The VA guaranteed 25% of that loan, which is $50,000. That $50,000 of your entitlement is currently tied up in that first property. To figure out your remaining entitlement, you take the VA's maximum possible guarantee, that $191,637, and you subtract the amount you've already used, that $50,000. The result is $141,637. That is your remaining entitlement. That's the amount the VA is willing to guarantee on a new loan. So, what's the maximum amount you can borrow for a second home with zero money down? Since the VA guarantees 25%, or 1/4 of the loan, you simply multiply your remaining entitlement by 4. In our example, you'd multiply that $141,637 by 4, which gives you $566,550. That is your new zero down payment limit. You can go out and buy a second home for up to that amount without putting a single dollar down. This is how service members can own multiple properties in multiple locations, building real, long-term wealth, all using their VA loan benefit. But what if the house you want to buy costs more than that? Let's say you want to buy a $600,000 home. Your zero down limit is $566,000. The difference is $34,000. Just like in the old days, you are now required to make a down payment of 25% of that difference. So you need to put down $8,500. It's not zero down, but it's still an incredibly small down payment for a $600,000 home. Far less than you'd need for almost any conventional loan. This calculation is the key. It's what separates the veterans who think they're stuck from the ones who are out there building a real estate portfolio. It all comes down to understanding the two paths. Path 1. You have your full entitlement. For you, the sky is the limit. The VA loan cap is a myth. Your only limit is what a lender will approve you for, based on your financial picture. Path 2. You have partial entitlement because you have another active VA loan. For you, the conforming loan limit still matters. It's the baseline for a formula. A formula that lets you calculate exactly how much more house you can buy, and how much, if anything, you'll need to put down. This change wasn't just a tweak to the rules. It was a fundamental reevaluation of what the VA home loan benefit should be. It was a recognition that the men and women who serve our country shouldn't be priced out of the very communities they protect. It leveled the playing field, transforming the VA loan from a great benefit with limitations into arguably the most powerful home financing tool on the planet. But knowing how much you can borrow is only half the battle. The other half is knowing what you can actually buy with it. Can you use a VA loan to buy a fourplex and live in one unit while renting out the others? What about a condo in a high-rise building? Can you buy a fixer-upper that needs a lot of work? The VA has very specific rules not just for the borrower, but for the property itself. These are called minimum property requirements, or MPRs, and they can make or break your deal. And that's our next critical mission: navigating the maze of property eligibility. The VA isn't just guaranteeing a loan for a person. It's guaranteeing a loan on a property. They are co-signing on your biggest life investment, and just like any smart co-signer, they want to make sure the investment itself is solid. They need to know that if, heaven forbid, you default on the loan, they aren't left holding the keys to a dilapidated, unsellable money pit. This isn't about being difficult. It's about risk management. But more importantly, it's about protecting you, the veteran. The VA's goal is to ensure you're moving into a home that is, in their words, safe, sound, and sanitary. Think of it as a final protective layer of armor. You've earned this benefit, and the VA wants to make sure it helps you, not hurts you, by getting you stuck in a home with a crumbling foundation or a leaky roof that will drain your bank account. So how do they do this? They deploy a specialist, a VA-approved appraiser. This person is not your home inspector. That's a separate inspection you should always get. The VA appraiser has a dual mission. First, they determine the fair market value of the home to make sure you and the lender aren't overpaying. Second, and this is our focus, they act as the VA's eyes and ears on the ground, verifying that the property meets these minimum property requirements, the MPRs. They have a specific checklist, and if the property doesn't tick all the boxes, the loan comes to a screeching halt until it does. Let's break down the MPR battlefield into its 3 core principles: safe, sound, and sanitary. First up, safe. This is all about protecting you and your family from immediate hazards. The appraiser is looking for anything that could cause harm. Does the property have a safe and reliable heating system? You can't have a VA loan on a house where the only heat source is a collection of space heaters. The furnace has to be in good working order and capable of maintaining a temperature of at least 50 degrees Fahrenheit. They'll check the electrical system. Are there frayed wires, exposed junction boxes, or other fire hazards? That's an instant red flag. What about the roof? It doesn't have to be brand new, but it must be in good condition and have a remaining economic life of at least a few years. A roof that's actively leaking or on its last legs is a no-go. They'll also look for things like missing handrails on staircases, which are a major safety issue. And a big one, especially in older homes built before 1978, peeling or chipping paint. This is a huge deal because of the risk of lead-based paint, which is highly toxic. Any peeling paint, inside or out, will almost certainly need to be scraped and repainted before the loan can be approved. Next, we have sound. This is all about the structural integrity of the home. Is the house literally going to stand the test of time? The appraiser will be looking at the foundation for major cracks or signs of settling. They'll check for evidence of water damage in the basement or crawl space, which could indicate drainage problems. Speaking of which, the property must have adequate drainage, directing water away from the house to prevent foundation damage. And a huge one here is pests, specifically wood-destroying insects like termites. In most parts of the country, a separate pest inspection, often called a termite inspection, will be required. If any active infestation is found, it has to be treated, and any damage it caused must be repaired. The VA wants to ensure the very bones of your house are strong and not being eaten from the inside out. Finally, we have sanitary. This is about basic livability and health. Does the property have access to safe, clean drinking water? If it's on a public water system, that's usually a simple check. If it has a private well, the water will likely need to be tested to ensure it's free of contaminants. The same goes for waste. The property needs a functional and safe sewage disposal system, whether that's a connection to a public sewer or a properly operating septic tank. The appraiser will also ensure that the property has adequate living space, with functional kitchens and bathrooms. They'll check that there's proper ventilation in areas like attics and crawl spaces to prevent moisture buildup and mold growth. Essentially, is this a healthy environment to live in? Now, this can sound intimidating. You might be picturing an appraiser with a white glove, looking for any tiny flaw to kill your deal. But that's not the reality. They aren't looking for a perfect house. They're looking for a safe, sound, and sanitary one. A house with ugly carpet or outdated kitchen cabinets will pass just fine. Cosmetic issues are not the VA's concern. They're focused on the core components that affect safety and value. So what happens if the appraiser finds an issue? Let's say they flag that peeling paint on the porch and a broken window in the garage. Is your dream dead? Absolutely not. This is where a new phase of negotiation begins. The appraiser will issue their report with a list of required repairs. Typically, the responsibility falls on the seller to complete these repairs before the loan can close. Your real estate agent will negotiate with the seller's agent to get the work done. In most cases, sellers agree because they want to sell their house, and these are often issues any other type of loan like an FHA loan would also flag. Once the repairs are completed, the appraiser will often do a final inspection to verify the work was done correctly, and then you're cleared to proceed. But what if the issue is bigger? What if the appraisal comes in, not with repair requirements, but with a value that's lower than your agreed-upon purchase price. This is a veteran's nightmare. Let's say you agreed to buy a house for $350,000, but the VA appraiser says it's only worth $330,000. The VA will only guarantee a loan for the appraised value. This is where a unique VA-specific protection comes into play called the Tidewater Initiative. If an appraiser thinks the value is going to come in low, they can invoke Tidewater. This pauses the process and gives your real estate agent 48 hours to provide the appraiser with additional comparable property sales that might support the higher price. It's a built-in second chance, an appeal process designed to make sure the valuation is as accurate as possible. If even after that the value is still low, you have three options. The seller can lower the price to match the appraisal, you can pay the difference in cash, or you can walk away from the deal entirely, and in most cases get your earnest money back. Again, it's a protection, preventing you from being immediately underwater on your mortgage. Understanding these property requirements is mission critical. It transforms you from a hopeful buyer into a savvy house hunter. When you walk through a potential home, you can start to see it through the eyes of an appraiser. You can spot the potential red flags, the water stain on the ceiling, the lack of handrails on the deck stairs, the peeling paint on the window trim. This knowledge gives you power. It helps you identify properties that are likely to sell through the VA process and avoid the ones that will turn into a nightmare of required repairs and renegotiations. Getting the property cleared by the VA appraiser is a massive milestone. It's the green light that says the home you've chosen is a worthy investment, not just for the VA, but for you and your future. You've proven your eligibility, you've secured your financing, and now you've found a home that meets the VA's high standards of quality. The finish line is in sight. All the paperwork, the searching, the waiting, it's all about to pay off. But there's one final push, one last set of hurdles to clear before you have the keys in your hand. And that is the closing process itself. The closing process, often called settlement, is where ownership of the property is officially transferred from the seller to you. It's a formal meeting, a ceremony of signatures and handshakes, and it all starts with one last visit to the property, the final walkthrough. Do not, under any circumstances, skip the final walkthrough. This isn't just a nostalgic last look before you own the place. It's your final inspection. This is your chance to verify that the property is in the same condition it was in when you agreed to buy it. You'll check that the seller has moved out completely, that no new damage has occurred, and that any contractually agreed upon repairs have actually been completed to your satisfaction. Turn on every light switch, run every faucet, flush the toilets, test the appliances, open the windows. You are confirming that you are getting exactly what you paid for. If you discover a problem, like a new hole in the wall hidden by a picture or a dishwasher that suddenly won't start, this is your last chance to address it with the seller before the money changes hands. Once you sign those final papers, that problem becomes your problem. Assuming the walkthrough goes smoothly, you'll head to the closing table. This is usually held at a title company or an attorney's office. You'll be sitting at a table with a stack of documents that looks like a small phone book. It can be incredibly intimidating. But don't panic. You're not expected to read every single word of every document on the spot. Your lender is required by law to provide you with a document called the closing disclosure at least 3 business days before your closing date. This is your cheat sheet. The closing disclosure, or CD, is a 5-page form that provides the final, detailed breakdown of your entire loan. The loan amount, your interest rate, your monthly payment, and a complete list of your closing costs. The numbers on this document should look very familiar, closely matching the loan estimate you received at the beginning of the process. Your job in those 3 days before closing is to review this document carefully. Compare it to your loan estimate. If you see a charge you don't recognize or a number that seems wrong, you call your loan officer immediately. You ask questions until you understand every single line item. By the time you get to the closing table, you should feel confident about what you're signing. At the table, a closing agent or attorney will guide you through the stack of papers. The 2 most important documents you'll sign are the promissory note and the deed of trust. The promissory note is exactly what it sounds like. It's your promise to repay the loan. It's your IOU to the lender, outlining the total amount you owe, the interest rate, and the terms of repayment. The deed of trust, or mortgage depending on your state, is the document that secures the loan with the property itself. It's the legal instrument that says if you don't honor the promissory note, the lender has the right to take the property through foreclosure. You'll sign your name over and over again. Your hand might cramp up, but with each signature, you are weaving the legal and financial fabric of your homeownership. Then it's time to pay. You'll bring a cashier's check or arrange a wire transfer for the amount of your closing costs and any down payment, as detailed on your closing disclosure. Once the paperwork is signed and the money is collected, the closing agent will begin the process of funding the loan. This is when your lender wires the loan amount to the title company, who then pays the seller, pays off their existing mortgage, and pays all the other parties involved like the real estate agents and the appraiser. Once the funding is confirmed and the new deed is officially recorded with the county, it's done. The transaction is complete. And then comes the moment you've been waiting for. The moment that makes every bit of stress and uncertainty worthwhile. The seller or their agent slides a set of keys across the table. They're yours. You pick them up. You feel the cool weight of the metal in your hand. You are no longer a veteran looking for a house. You are a homeowner. But the journey doesn't end when you get the keys. In fact, a new one is just beginning. Being a successful homeowner is about more than just making your mortgage payments. First, let's talk about that payment. Your first mortgage payment isn't usually due on the first of the next month. You'll typically skip the next calendar month. So if you close on May 15th, your first payment won't be due on June 1st. It will likely be due on July 1st. This gives you a little breathing room, but don't get too comfortable. That first payment will come faster than you think. Your loan servicer, the company that will collect your payments, will send you a welcome packet with all the information you need to set up your payments online. Do it immediately. Set up autopay. The single best thing you can do for your credit and your peace of mind is to never, ever be late on a mortgage payment. Next, as soon as you get settled, you need to look into filing for a homestead exemption. This is a huge deal that so many new homeowners miss. A homestead exemption can reduce the taxable value of your home, which in turn lowers your annual property tax bill. The rules and the amount of the exemption vary widely by state and county, but it can save you hundreds, sometimes thousands of dollars every single year. And for veterans, especially those with a disability rating from the VA, there are often additional, even more significant property tax exemptions available. You have to apply for these exemptions. They are not automatic. Go to your local county tax assessor's website, find the forms, and file them as soon as you are eligible. It is literally free money you are leaving on the table if you don't. Now let's talk about the reality of owning a home. Things break. Water heaters fail. Air conditioners give out. Roofs leak. This is why it is absolutely critical to start a dedicated home maintenance and repair fund. That breathing room you got before your first mortgage payment? Use that time to kickstart this fund. Financial experts often recommend saving 1 to 3% of your home's purchase price each year for these expenses. So for a $300,000 home, that's at least $3,000 a year, or $250 a month, that you should be setting aside. This isn't your emergency fund for a job loss. This is a specific, planned fund for the inevitable costs of homeownership. Being prepared for these costs is the difference between a minor inconvenience and a major financial crisis. Finally, remember that your VA loan is a benefit you can use more than once. And one of its most powerful features for the future is the Interest Rate Reduction Refinance Loan, or IRRL, often called a VA Streamline Refinance. If interest rates drop significantly in the future, the IRRL allows you to refinance your existing VA loan to a new one with a lower rate, quickly and easily, often with no appraisal and minimal paperwork. It's a tool to keep in your back pocket that can save you a fortune over the life of your loan. From the first moment you wondered, am I eligible? To holding the keys to your own front door, the VA home loan journey is a marathon. It's a testament to your service and a benefit you have profoundly earned. It's a path paved with paperwork and patience, but it leads to a place of stability, pride, and belonging. Place to call your own. The VA loan isn't just a financial product, it's a promise kept. A nation's thank you delivered in the form of a front door, a backyard, and a roof over your head. You've served our country. Now go build your American dream. You've earned it.